Chapter 2. Debit and credit transactions. The key points in this chapter are: debits are increases in money for the company, they're plus money. Credits are reductions in money for the company, they're minus money. Debits can either be an increase in a money in item or a reduction in a money out item. Credits can either be a reduction in a money in item or an increase in a money out item. Bank statements are from the bank's perspective, not the customer's, and the opposite way round to the company's bank account in their accounting system. If double entry bookkeeping were invented today, the terms would be plus money and minus money. Nobody knows where debit and credit terms come from, as they were invented hundreds of years ago in the sort of 15th century in Venice, really, in terms of where it was written down, and it was invented probably in India in the 5th century AD. Nobody knows where those debit and credit terms come from. But now that they exist and every accountant knows them, this is the terminology used, and you will have to get used to it really, rather than plus money and minus money. But in a digital accounting system, you will simply see plus money and minus money rather than debits and credits. Debits is plus money. It represents either an increase in an asset, so an increase in a money in item, plus times a plus, or a reduction in a liability, or share capital, a reduction in a money item, a minus times by a minus. Credit is minus money. It represents either a reduction in an asset, so a reduction in a money in item, so a plus times a minus, or an increase in the liability or share capital, so an increase in money out item, so a minus times by a plus. Students often get confused initially because this is the opposite around of their bank statement, where plus money, money coming in, is a credit on the bank statement, and minus money, money going out, payments being made, is a debit. So here we have a bank statement here, and I've sort of got these payments out here described as debits, and then they're reducing the balance, and I've got these payments coming in and described as credits, and they're increasing the balance. Now I've got the bank statement here, and for ease of reference I put the actual company account over here. We'll do T accounts in a couple of chapters time, but you can see here that actually payment out on the bank in the bank account in the general ledger for the company is a credit side in here, debit side. Why is this the case? Well, the reason is because the bank statement is payments to the bank, or payments from the bank, so it's from the bank's perspective really in here. So if an account is in credit, it means that the bank, you are a creditor to the bank, so the bank has you as a creditor. It's money that's going to go out from the bank to you. Similarly, if you're in debit, so there's you make payments from the bank account, and therefore you owe the bank account money in there, so you're a debtor to them. So that's the reason for it, is because the bank statement is from the bank's perspective, not yours. So in terms of the bank's accounts within its ledgers, that's how it looks. So it's on the bank's account. Now it doesn't seem very customer friendly to produce things from the bank's perspective, not from your perspective. But to change that approach now would just cause chaos. So we have this following diagram to set out what is a debit and what is a credit in here. So we have our accounting equation here, assets equals liabilities plus capital here. So our money in items must be equal to our money out items, because the shareholders are going to get whatever's left over from the assets after all the liabilities have been paid off there. So we've got our money in items, our assets. And so if they're increasing, that's plus money, and that's debits. And if they're reducing assets, then that's less money in, so that's minus money, and that's a credit. If our liabilities or share capital are increasing, that's more money coming out, so that's minus money, that's a credit. And if we have our reducing liabilities or reducing share capital, then that's reducing money going out, that's plus money in there, so less money going out, plus money in there, and so that's a debit. So just in terms of where we are then, and we have our assets equals liabilities plus capital, and increase in our assets, debit, reduction in our assets, credit, increases in our liabilities or capital, credit, reduction in our liabilities and capital, debit.